Hi and welcome to Swissquote's Daily Market Talk. It's Friday, October 31st. A week full of central bank decisions and big technology earnings is coming to an end after some twists and turns. In one sentence, big technology beat expectations, but their pledge to increase their AI spending didn't echo well after Jerome Powell from the Fed said that they're not sure that there will be another 25 basis point cut down the road this year. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So US markets were down yesterday as investors asked many questions about the pledge of higher AI spending from the big technology companies, even though all of these big technology names that actually revealed their results this week beat the lofty market expectations, both on earnings, on their revenue, and on their cloud business for those who actually have it. So all of these results were better than expected. Alas, Nasdaq 100 fell nearly 1.5% yesterday as Microsoft shed nearly 3% after announcing their earnings. Meta took an 11% hit and was sent straight below its 200-day moving average and couldn't find enough buyers to clear that level, while Google opened the session at an all-time high level but spent the session giving back these early gains to end the session with a relatively meager 2.45% gain. That was quite meager again for a post-earnings session. But I truly believe that the bearish reaction that we saw to these big technology earnings has somehow a lot to do with the macroeconomic context of the moment and with the rising yields after Jerome Powell said earlier this week after the Fed decision that it is not sure that there will be another 25 basis point cut come December. Now the good news is Apple and Amazon added another layer of better than expected earnings after the bell yesterday. Apple, for example, which is obviously not the hottest AI play in the town, well, they still did better than expectations because they managed to, sell more iPhones than expected last quarter, and that came as a good news along with better guidance for the coming holiday season, while Amazon surprised investors toward the upside with the fastest growth in its AWS unit since 2022. So that came as excellent news for those investors who earlier this week were questioning the massive spending of these big technology companies in building these data centers. But the truth is, these companies, these big technology companies, are stepping up their efforts and their spending to catch up with the already existing demand, which according to Microsoft is significantly higher today than what they could provide, what they could meet. And because AI applications are expected to double the need for computing power every 9 to 18 months, this gap between demand and supply, will probably only diverge as AI applications emerge. So these data centers are needed, and these companies' efforts to stay on course may look a little bit exaggerated, especially now that the earnings are not necessarily reflecting the payoff of these investments. But none of these names could afford today to be, kicked off the race or stay on the back foot, not after having already spent so much already. So I wouldn't be much worried about the huge spending until there are hints out there about oversupply, which is not the case right now according to what we've been reading in the news lately. Anyway, that being said, the big technology pulls off the earnings season quite well despite the mixed market reaction to these earnings, which again is partly and mostly in my opinion due to the Fed disappointment this week, and Nasdaq futures are looking better at the time I'm talking here this morning after Amazon's AWS growth brought some optimism to the mix. So Amazon, which lagged behind the Magnificent Seven stocks this year since the April rebound, soared 13% in the after hours trading, printing the biggest post-earnings gain of the week among the big technology companies that released their earnings this week. Voila. Today, American oil giants will be going to the earnings confessional, with analysts expecting modest year-over-year declines as softer oil and gas prices weigh on their results. Both face the same challenge, proving that they can protect profitability and capital discipline in a lower price environment, while obviously keeping investors confident about cash returns and also the production outlooks. As per oil, well, the past week's tactical long positions on the renewed tensions with Russia on Rosneft and Lukoil sanctions, remember, are taking their profit probably and walking away. So the barrel of US crude has seen support near the $60 per barrel level this week, but there is probably a greater chance of a further slide below the $60 per barrel psychological support than the contrary, if especially the US dollar continues to recover, which is the case right now because the US dollar has been on a positive rise since the Fed Chair Jerome Powell didn't want to offer that December cut to investors on Wednesday. So the euro dollar consolidates losses this morning below the 116 psychological mark after the European Central Bank kept its rates unchanged at yesterday's monetary policy meeting as expected, with Christine Lagarde repeating that the ECB's policy is in a good place right now and they will do whatever is needed to keep it that way. Now, European policymakers, on the other hand, sounded more optimistic than before, and that was thanks to these easing downside risks to the European economies, mostly thanks to the easing trade tensions with the United States. They kept their inflation outlook for the Eurozone broadly unchanged, which is almost close to 2% target anyway, and traders now price in no more rate cuts from the European Central Bank over the next year. But despite that relatively hawkish stance from the ECB, the euro-dollar may not reverse its toppish formation if the Federal Reserve expectations become more hawkish on their end, simply because the European Central Bank's pause was broadly expected and priced in, but the Feds come as a surprise. So today, the Eurozone will be revealing its October preliminary inflation figures for the Eurozone that are expected to hint at slowing inflationary pressures across the region, which could further strengthen the euro bear's hand in the short run. Across the channel, while cable took a harder hit than many other major currencies this week, and the pair is now testing the major 38.2% Fibonacci support on the year-to-date rally. If broken, we'll be sending the pair into the medium-term bearish consolidation zone, and that would be increasing the possibility of a deeper pullback in the sterling dollar. That would also make sense from a fundamental perspective, mind you, where sterling looks unappetizing right now into the autumn budget of next month. And finally, the dollar yen rose to 154.45 level yesterday on dovish shift in Bank of Japan expectations due to the new Prime Minister Takaichi's explicit preference for a softer monetary policy than the contrary, and probably a softer yen as well. And in the metal space, gold is set to print a second week loss, but the selling pressure here this week eased significantly compared to last week, and we haven't seen further outflows despite higher US yields, a stronger US dollar after the Fed decision, and easing trade tensions across the board. The volatility remains relatively high, hinting that we could see a further pullback in bullion's price in the coming weeks before an eventual return to calm, but the long-term outlook for gold has not changed. It remains positive as exploding US and developed market debt levels, unappetizing major currencies, and central banks' willingness to build these gold reserves and expand off US treasuries in a broadly uncertain geopolitical environment remain supportive of gold and other hard assets in the medium to long run. So in this context, precious metals, including gold and silver, industrial metals, including copper, and rare earth metals will likely remain in demand. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions. answer your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.
This content is intended for individuals who are familiar with financial markets and instruments and is for information purposes only. The presented idea, including market commentary, market data, and observations, is not a work product of any research department of Swissquote or its affiliates. This material is intended to highlight market action and does not constitute investment, legal, or tax advice. If you are a retail investor or lack experience in trading complex financial products, it is advisable to seek professional advice from a licensed advisor before making any financial decisions. This content is not intended to manipulate the market or encourage any specific financial behavior. Swissquote makes no representation or warranty as to the quality, completeness, accuracy, comprehensiveness, or non-infringement of such content. The views expressed are those of the consultant and are provided for educational purposes only. Any information provided relating to a product or market should not be construed as recommending an investment strategy or transaction. Past performance is not a guarantee of future results. Swissquote and its employees and representative shall in no event be held liable for any damages or losses arising directly or indirectly from decisions made on the basis of this content. The use of any third-party brands or trademarks is for information only and does not imply endorsement by Swissquote, or that the trademark owner has authorized Swissquote to promote its products or services. Swissquote is the marketing brand for the activities of Swissquote Bank Limited, regulated by FINMA, Swissquote Capital Markets Limited, regulated by SISEC, Swissquote Bank Europe SA, regulated by the CSSF, Swissquote Limited, regulated by the FCA, Swissquote Financial Services Limited, regulated by the Malta Financial Services Authority, Swissquote MEA Limited, regulated by the Dubai Financial Services Authority, Swissquote PTE Limited, regulated by the Monetary Authority of Singapore, Swissquote Asia Limited, licensed by the Hong Kong Securities and Futures Commission, and Swissquote South Africa Limited, supervised by the FSCA. Products and services of Swissquote are only intended for those permitted to receive them under local law. All investments carry a degree of risk. The risk of loss in trading or holding financial instruments can be substantial. The value of financial instruments, including but not limited to stocks, bonds, cryptocurrencies, and other assets, can fluctuate both upwards and downwards. There is a significant risk of financial loss when buying, selling, holding, staking, or investing in these instruments. Swissquote makes no recommendations regarding any specific investment, transaction, or the use of any particular investment strategy. CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. The vast majority of retail client accounts suffer capital losses when trading in CFDs. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. Digital assets are unregulated in most countries and consumer protection rules may not apply. As highly volatile speculative investments, digital assets are not suitable for investors without a high risk tolerance. Make sure you understand each digital asset before you trade. Cryptocurrencies are not considered legal tender in some jurisdictions and are subject to regulatory uncertainties. The use of internet-based systems can involve high risks, including but not limited to fraud, cyber attacks, network and communication failures, as well as identity theft and phishing attacks related to crypto assets.